Hello, my name is Bhavya Upadhyay. I am recording this presentation for the purpose of my CA industrial training. Please note that the contents of this video are purely for educational analysis and do not constitute any professional investment advice.
At global scale, two clear trends are reshaping the economy. First, the China Plus One strategy is creating opportunity of new manufacturing hub outside China. And second, the rapid evolution of artificial intelligence. While AI is bringing disruption to white-collar IT industry, the blue-collar capital-heavy manufacturing sector is the least disrupted area. Capital incentive auto sector demands capex not only limited to plant and machinery or research and development, but auto sector also required nationwide after-sales service network. For example, Ola through capital meet the research and development and manufacturing stage, yet the stock price is struggling due to service network failure. As I am also facing service related issue in my Ola, combining the China Plus One as well as rapid evolution of AI and the auto sector requirement, this puts India's auto manufacturing sector as a primary growth engine of the economy. Recognizing this, Government of India has developed production linked incentive scheme. Around 26,000 crore was injected through PLA scheme in auto sector. Diving deep into the auto industry metrics, the Indian auto sector contributes around 6% in national GDP, having total addressable market of roughly 20 lakh crore, compounding at average annual growth rate of 8%, putting direct benefit from PLI scheme and GST rate cut into action. As of now, rural market is contributing around 40% of industry's revenue as rural income increases due to good agriculture harvest. Also, the consumer behavior is shifting toward high margin SUV. Historically, Indian market was volume game. First time buyer was opted for low margin entry level hatchback. Now the trend is changing towards high margin SUV and sub 4 meter SUV. Same time, government is incentivizing transition to electric vehicles to align with developed market like US, UK, EU demand, creating dual opportunity for Mahindra and Mahindra, Hyundai, Tata Motors. Before going into any specific company, let's look at the auto sector at large, as the auto sector at large is heavily exposed to raw material cycle like hot rolled steel coil price, which peaked around 2022.
This chart confirms the raw material price are keep increasing day by day.
And whenever raw material cost increases, any manufacturer have three options. First, to absorb cost and suffer margin reduction. Second, raise sale price and lose volume, or improve the product mix. Because entry level cars operate on thin margin, they suffer the most, whereas premium SUV segment having price inelastic buyer who are willing to pay premium for advanced features. Let's evaluate financial health, capital allocation, and future visibility of top listed manufacturer in India. Starting with the Hyundai Motors. The Hyundai Motors operates in highly lucrative mid-premium SUV segment, which gives more margin than entry-level car and more volumes than the full-fledged SUV cars. As result of this sweet spot segment, pre-IPO Hyundai generated impressive return on equity and return on capital employed driven by high asset turnover and around 12% operating profit margin thanks to the sales being highly concentrated around SUV Creta of this segment. But taking a closer look, post-IPO sales are largely stagnated around 70,000 crore with operating profit margin of 12%. As Hyundai's fixed assets are increasing, clubbed with stagnated sales, the asset turnover ratio and ROCE both are declining, dragging down the return on equity. As Hyundai's portfolio is dangerously concentrated in mid-premium SUV sweet spots through Creta and EV version of Creta, Hyundai is facing competition as BYD, VinFast, MG and Mahindra are also now focusing on this margin volume sweet spot, creating battlefield impacting both volumes and margins for Hyundai. As the competition increases in future, further impact can be observed on ROE. Hyundai was already listed at premium valuation during its absolute peak of its operating efficiency. As a result, the competition is now forcing Hyundai Motors to give examination onto their current valuation, whether their current valuation are justifying or not. As of now, promoters hold around 80% of equity. Now in near future, when promoter reduces their holding, let's say to 75%, then if due to this battleground situation, ROE will reduce, then weak hand will not be able to hold stock as result into reduction in Hyundai's valuation. To conclude, for the Hyundai motor, the core risk is in the product concentration because increased competition intensity in mid-premium SUV segment as Mahindra & Mahindra, MG, BYD and VinFast entry creating battleground for volume and margin. On the other hand, Hyundai listed at absolute peak of its operational efficiency at premium valuation. Any margin reduction due to price or volume war will make Hyundai high risk investment. Moving on to Maruti Suzuki, volume to value pivot. Maruti Suzuki is generating around 12% operating profit margin at sale of 1,80,000 crore while maintaining material cost at 70%. In economy where raw material prices are increasing, likely to trigger the material cost being maintained with 20% contribution from premium Nexa distribution channel indicates Maruti Suzuki's pivot from low margin cars to high margin cars like Fronx, Grand Vitara, which is also reflected in the balance sheet and loss account, showing increase in sales or say increase in sales trend, profit margin, return on capital employed, creating value for equity holders through the Maruti's strategy. Talking about Maruti's strategy, Maruti is utilizing a highly calculated powertrain transition wherein Maruti Suzuki is maintaining sales volume through factory-fitted CNG cars, introduction of flex fuel cars like WagonR, Fronx, and exporting the surplus capacity to Africa and Latin American as well as Middle East countries which are ICE friendly. Maruti is cautiously entering into EV space with partnership with Toyota through which management is reducing EV capital risk and preparing to re-enter in the European market with EV car e-Vitara at lowest possible cost risk. Simultaneously, Maruti is building cars as per European Union and Japanese quality standards so that the brand value of Maruti Suzuki can further increase, which in turn help Maruti Suzuki in future whenever they are ready to produce or say to manufacture full-fledged SUV cars in India as well as all over the economic of world with maintaining service quality. For good return, investment needs to be made at reasonable price in good companies. Apart from PEG ratio of around 1, the Maruti Suzuki historically speaking, the price to earning ratio as well as the EV/EBITDA multiples are indicating that the Maruti Suzuki in comparison of its history is sitting at fairly valued range along with highest interest coverage ratio. This Maruti Suzuki's trade stock being at fairly PE and EV/EBITDA multiples making Maruti Suzuki moderate to reward investment with low risk. Next is Mahindra and Mahindra, a highly diversified conglomerate business with strong cash flow from premium SUV, farm equipment, financial services, and Tech Mahindra business. Mahindra and Mahindra is undisputed king of SUV segment, generating around 50% operating profit margin zone with round-up sale of 2 lakh crore, simultaneously maintaining material cost around 60% zone. This 60% material cost demonstrate absolute pricing power over their consumer base through SUV and tractor, supported by steady cash flow from operations and growing CAGR trend across the board. Healthy interest coverage ratio indicates fabulous work done by Mahindra and Mahindra's management through which they have gained the investor trust reflected in the stock price of Mahindra and Mahindra. Although Mahindra and Mahindra is investing in EV, management have cleverly maintained the focus area very clearly to target high margin auto sector of EV SUV, as Indian government charges only 5% GST on EV in comparison to massive GST slab of 18% to 40% on ICE cars like Bolero Neo or Scorpio. This 13 to 35% tax discount creates massive financial buffer which allows Mahindra and Mahindra to handle higher material cost of EV batteries without passing pain to the customer or sacrificing on their operating profit margins. Collectively speaking, as India's EV transition accelerates and backed by PLI scheme PM E-Drive, Mahindra and Mahindra is enjoying SUV super cycle of both EV cars as well as ICE cars in parallel by opening export channels to ICE friendly nations like South Africa, Australia, ultimately creates diversified revenues across the nation, reducing the risk of policy change in one nation. Observing historical valuation data of Mahindra, we can say current valuations are in the fairly valued zone in terms of PE as well as EV/EBITDA. Now let's talk about Tata Motor passenger vehicles because JLR production stop is affecting the overall performance of Tata Motor. But even after that, Tata Motor did generate the sales well above 3 lakh crore at operating profit margin of 6%. As the Tata Motor faced different year, we are going to look at standalone statement of Tata Motor passenger vehicle to get the idea about the business.
This standalone
Financial statement indicates the Tata Motor passenger vehicle in last 5 years incurred material cost between 70% to 75% zone, which is more similar to the Maruti Suzuki, which operates in a non-SUV segment despite having branded SUV cars like Tata Safari, Tata Harrier, and the operating profit margin of Tata Motors showing extreme or quite a volatility. Thus, we are going to look at product mix and future vision of Tata Motor passenger vehicle. Tata is pushing EV across all segments, including low margin EV, whereas government is offering GST discount up to 35% in SUV segment. EV manufacturing costs are higher than ICE engine car manufacturing cost. By launching EV into highly price sensitive entry level market, the margin becomes extremely low. And if the government removes special 5% GST on EV, then all the promotion cost
and other efforts made by
Tata Motors over the year in low entry ticket cars or say low margin entry level cars will be wasted, or the brand image of Tata Motor can be damaged due to this. And unlike Mahindra and Mahindra, Tata is deploying capital to fight a multi-front war across vehicle segment. This strategy will surely bring volumes, but the profit are going to be hard to make in future. From the current balance sheet and history of Tata management, the Tata surely can survive in coming years. But until Tata Motor pivot to high margin with clear focus on SUV segment and Tata Motor gain command on cost, till then the stock will consolidate around its attractive book value zone. Tata Motors successfully boosted its sales volume, but it also diluted the presence. Presence of Tata Motors in all the segments makes it hard to predict the future cash flows. Now, until the Tata Motors control this volatility and makes it easy for market to visualize the aim of Tata Motors, the stock price of Tata Motors is expected to consolidate around the book value of its balance. Now, moving forward to Hyundai Motors, the historically dominated mid-premium SUV sweet spot of Hyundai is now becoming battleground for major EV players, which indicates if in future the Hyundai Motor did not carve out, Hyundai Motor did not improve its sales in according to the fixed asset improvements, and the asset turnover multiplier will reduce the return on equity, furthering down impacting the stock price. On the other hand, as Hyundai was listed at premium valuation, now Hyundai is in the situation where Hyundai Motors management need to justify their current valuation, let alone the future growth scope. Now moving on to the Mahindra and Mahindra. The Mahindra and Mahindra commands over the high margin SUV portfolio along with price insensitive customer base gives Mahindra and Mahindra structural advantage to maintain high margin and tackle the raw material inflation, along with exploiting the GST tax benefit will collectively make EV transition smoother for Mahindra and Mahindra. On the other hand, Maruti Suzuki, through avoiding early entry in EV space, allows Maruti Suzuki to avoid EV capital burn, which was used to upgrade Maruti Suzuki's product portfolio mix towards high-margin sub-4-meter SUV while maintaining sales volume through global export. Now, through the combination of Mahindra and Mahindra along with Maruti Suzuki gives us flexibility as well as focus area of each company. Through the combination of Mahindra and Mahindra and Maruti Suzuki, we are having all-rounded portfolio.
That is, the combination of these two companies we can cover each and every car segment like Maruti Suzuki covers hatchback to the mid-size SUV with focus on sub-4 meter SUVs, whereas
And Mahindra, on the other hand, covers from sub 4 meter SUV till the full-fledged SUV car along with the full-fledged EV SUV cars. Mahindra focusing on mid-size SUVs ensures our portfolio have two dominating area already and two future focus area where one will dominate and other will cover significant share. This allows us to increase or decrease our exposure to the both car manufacturing technology. If in future EV trend becomes new normal, then we can increase our exposure to Mahindra and Mahindra, and in case EV transition backfires, then we can increase our exposure to the Maruti Suzuki, or we can maintain our current well-balanced exposure to the both technologies. This portfolio mix gives us benefit of both Tata Motors as well as Hyundai Motors with improved focus on each segment and reasonable valuations, giving our portfolio a room for growth.